Assalamualaikum warahmatullahi wabarakatuh. Hi, my name is Syahazwani Nurain Binti Shariman Faizul. My metric number is 72701 and my supervisor for my final year project this semester is Dr. Shariman bin Abdul Rahman. Welcome to my presentation. So, today I'm going to present about my FYP that is comparison of 4 technical analysis indicators: moving average convergence divergence MACD, relative strength index RSI, Bollinger Bands, and stochastic oscillator. So, I will start with chapter 1, that is the introduction. Here's an overview of content that is included in my chapter 1. First, I will talk about the background of study for this topic, and then we'll go into the problem statement. Next is the aim and objectives, and further I will briefly explain about the methodology applied in this study, and the scope, moreover the significance of study, and lastly I will present the expected outcome of this study. Let us first dive into the background of study of this topic. Why did I decided to study about comparison of 4 technical analysis indicators, that is the moving average convergence divergence MACD, relative strength index RSI, Bollinger Bands, and stochastic oscillator? Well, first of all, investing has become a more popular activity over the past few years given the disappearance of pension plans in the private sector. This is because in the past, many companies offered defined benefit pension plans to their employees, which provided a guaranteed source of income in retirement. However, in recent years, many companies have moved away from these types of plan in favor of a more defined contribution plans, which then shift the responsibility of saving for retirement onto the individual. Hence, many individuals have been forced to take a more active role in saving for their retirement, which has led to an increase in the popularity of investing. And the type of investment being studied in my work is investment in stock market. Stock market is a type of financial market that exists for the purpose of issuing, buying, and selling stocks that are listed on stock exchange. What is stock market? Well, stock market are referred to as several different exchanges where shares of public companies can be bought and sold on daily basis. There are many stock exchanges available today. However, there is this one most well-known stock exchanges in the US known as the NASDAQ, National Association of Securities Dealers Automated Quotations. And the NASDAQ Stock Exchange provides indices such as the NASDAQ 100, which is a market capitalization weighted index that includes the 100 largest most actively traded companies listed on the NASDAQ. In this study, I've chosen the top 10 companies listed in the NASDAQ 100 index. The companies are Apple Incorporation, Microsoft Corporation, Amazon.com, Facebook Incorporation, Tesla, Alphabet Incorporation, Nvidia Corporation, Intel Corporation, Cisco System Incorporation, and Adobe Incorporation, with the purpose to provide investors with valuable information that can help them make more informed investment decisions and potentially achieve higher returns on their investment. Therefore, this study focuses primarily on technical analysis and more specifically on the different technical analysis indicators to analyze historical price in order to gain a comprehensive understanding of what is likely to happen in future when the market moves forward. Hence, a study will be conducted by performing backtesting on the 4 technical analysis indicator, that is the MACD, RSI, Bollinger Bands, and stochastic oscillator on the US stock in order to further test and compare their performance. Next, I will elaborate on my problem statement. With the decline of traditional pension plans and the shift towards individual retirement savings, more individuals are relying on investing as a means of securing their financial future. However, this increased reliance on investing also leads to greater risk and uncertainty, as market fluctuations and individual investment decisions can greatly impact the success of one's retirement savings. As a result of the fluctuating and unpredictability of the stock markets, investors are prone to make a number of mistakes when it comes to making investment decisions that could be detrimental in the long run. Therefore, investors need to have an effective strategy in order to be able to make good investment decisions. Investors should apply what they deem as the best indicators in their strategy, and this can be done by conducting proper analysis beforehand. However, the interpretation of indicators can be a complex process for amateur investors, since it calls for knowledge, skills, and a detailed understanding of how to use them properly. Therefore, this study is conducted by doing comparison between 4 different technical indicators with the purpose to determine the best technical analysis indicator. Then, here is the aim and objectives of the study. The aim of a study comparing 4 technical analysis indicators such as the moving average convergence divergence, relative strength index, Bollinger Bands, and stochastic oscillator would be to evaluate their relative effectiveness in predicting stock market trends and making investment decisions. The objectives of such a study could include to evaluate the performance of each indicator in historical market conditions, measured by the rate of return achieved using each indicator during the backtest period, to determine the consistency of each indicator in generating profitable trades, measured by the ratio of profitable trades generated by indicator during the backtesting period. Next slide on methodology. Here I will briefly mention the 4 processes in my methodology. First is the data collection and pre-processing, following with defining the rules of the strategy, and then analyzing the overall result. Lastly, optimization process. A more in-depth of each processes will be explained in chapter 3. Next, the scope of this study is to compare the performance of 4 technical analysis indicators, MACD, RSI, BB, and SO using TradeStation. The study will focus on the US stock market and will be conducted using historical stock market data, specifically daily close prices for a period of at least 10 years. The study will include backtesting, optimization on selected parameters of the strategy, walk-forward analysis using cluster analysis, and sensitivity analysis. The significance of this study is to provide investors with a comprehensive evaluation of 4 commonly used technical analysis indicators, MACD, RSI, BB, and SO, in the US stock market. Other than that, the results of this study can help investors to make more informed decisions and enhance their trading performance. Additionally, the study would also contribute to existing body of literature on technical analysis by providing a comparison of 4 commonly used indicators in the US stock market. Lastly, the expected outcome of this study will present a detailed analysis of the performance of each indicator over a period of 10 years in the US stock market, and recommendations for investors on which technical analysis indicator to use in different market conditions. Now, let us dive into the next chapter, that is the literature review. Here is the content of my literature review. I will expand on the type of technical indicators used in the study and describe each one of these indicators. I will also explore the strengths and weaknesses of these indicators, and lastly, comparison of related works. A technical analysis indicator is merely a way of reworking and visualizing market data. It takes price information and reworks it in new and interesting ways, and they are all the result of mathematical calculations with different objectives, but ultimately they are all based on the same price information on a chart. Indicators can be categorized into 2 groups, either lagging indicators or leading indicators. Lagging indicators. It is a tool that produces delay signals, which means they provide a signal after the price movement that has already passed or is still happening. These lagging indicators are typically used by investors to confirm the trend of prices before entering a trade. For example, the MACD indicator and the BB indicator are 2 indicators that can be used to demonstrate this. Leading indicators are tools that serve as forecasts of the future direction of a market in order to give investor a chance to predict market movement ahead of its time. An example of such indicator would be relative strength index RSI and the stochastic oscillator. Next, MACD indicator. The MACD indicator is one of the most popular indicators used in technical analysis. MACD is a combination of two different types of indicators, which is why it is so informative in this sense that it identifies the direction of the trend as well as its duration. First, MACD employs two moving averages that vary in length, which are lagging indicators, to determine the direction and duration of the trend. MACD then plots the difference between the two lines of moving averages, MACD line, and an EMA of those moving average signal lines as a histogram that oscillates above and below the zero line in center of the chart. By analyzing the histogram, it is possible to determine whether a security has momentum or not. The Bollinger Bands are composed of a band consisting of three lines that are plotted in relation to the price of the security. A simple moving average SMA is usually used in the middle of the chart, preferably with a period of 20 days. The SMA then serves as baseline for the upper and lower bands, which are then used to measure the volatility of a given market by studying the relationship between the bands and the price of the market. RSI is a momentum-based oscillator that is used in order to measure both the speed velocity as well as the changes magnitude in the direction of price movement. It is a very effective and popular indicator for taking price momentum into account. As such, when RSI is plotted on a graph, it can produce a visual mean that allows in monitoring both the current as well as historical strength and weaknesses of particular market at a glance. The strength and weaknesses of a stock is calculated by comparing closing prices over the duration of specified trading period, creating a reliable metric for analyzing price and momentum changes. The stochastic oscillator can be defined as a momentum oscillator that is range-bound. It is designed to show the location of close in comparison to the high-low range over a number of periods that is defined by the user. There are three main things that the SO is commonly used for, and these are to identify overbought and oversold levels, to spot divergence, and also to identify bullish and bearish setups or signals at the same time. Strength and weaknesses of each indicator is shown here, such as the MACD. The strength can help traders identify the direction and strength of a trend and is also useful for identifying potential buy and sell signals. However, the weakness is that MACD can generate false signals in a ranging market, and it can also be slow to signal a change in trend. Next, Bollinger Band. Bollinger Band can help traders identify the relative high and low prices of security and can be used to identify potential buy and sell signals, such as when the price touches the upper or lower band. The weakness of Bollinger Band is that it can generate false signals in a ranging market, and they can also be slow to signal a change in trend. RSI can help traders identify overbought or oversold conditions in a security and is useful for identifying potential divergences between price and the RSI, which can indicate potential buy and sell signals. However, the weaknesses of RSI is that it is susceptible to false signals in a ranging market, and it can also be slow to signal a change in trend. Lastly, a stochastic oscillator can help traders identify overbought and oversold conditions in a security and is useful for identifying potential divergence between price and the stochastic oscillator, which can indicate potential buy and sell signals. The weakness is it can generate false signals too in a ranging market, and it can also be slow to signal a change in trend. Lastly, this here is the comparison of related work I have compiled that are related in this field of study, such as the paper by Pramudia and Ichsani titled Efficiency of Technical Analysis for Stock Trading. The similarity of this chapter with my current study is that it compares technical analysis indicators such as the MACD, Bollinger Bands, and RSI indicators. However, the differences is that my current study is conducted on the comparison of indicators on the US stock market, Nasdaq 100 index, and using method of comparative study and backtesting. The next paper by Ivanovsky titled Technical Analysis Accuracy at Macedonian Stock Exchange has similarities such as comparing technical analysis indicators, MACD, stochastic, and RSI indicators. In contrast to my study, the Bollinger Bands were also added to the list, as well as an observation was made concerning the stock market in the US. And lastly, paper titled Various Moving Average Convergence Divergence Trading Strategies, a comparison. It has similarity in application of MACD in their study, and MACD is the most widely used technical analysis indicator. It is being utilized in this paper to estimate the profitability of an indicator, return of investment, derived from that indicator. And as opposed to analyzing 4 indicators such as MACD, BP, RSI, and ESO, this paper focuses exclusively on MACD and discusses Indonesia's capital market. This is the last chapter for my final year project this semester, that is the methodology. Here's an overview of this chapter, such as the framework of research, data collection, ethics, limitation, and lastly, conclusion. Framework of research includes few steps such as first, define the rules of strategy where entry criteria for MACD is to buy when the MACD line crosses above the signal line. For RSI, buy when RSI goes above a certain level, for example 70. For Bollinger Bands, buy when the price closes above the upper Bollinger Band. And for stochastic oscillator, buy when the percentage K line crosses above the percentage D line. The exit criteria for MACD, sell when the MACD line crosses below the signal line. And for RSI, sell when RSI goes below a certain level, for example 30. Bollinger Bands, sell when the price closes below the lower Bollinger Band. And lastly, stochastic oscillator, sell when the percentage K line crosses below the percentage D line. The next step is to analyze the overall results, and a worth pursuing strategy should have these metrics such as strategy should generate positive net profits, and it should generate at least 30 trades. Evaluate if the max profit is an outlier, indicate high volatility and instability of the strategy. And strategy that generates a high percentage of profitable trades is likely to be successful. Other than that, strategy should have low drawdown, which lower the risk, and strategy should have an upward sloping equity curve. The third step is the optimization process. First, identify the parameters that can be optimized. These are the variables of the strategy that can be adjusted to improve its performance. Example of this can be the periods used in the technical indicators, the stop loss and take profit levels, or the position sizing rule. Then define the range of parameter values. Determine the range of values for each parameter that will be used in the optimization. For example, the range of values for the period of the moving average can be from 5 to 30 days. And then we run the optimization. Use the backtesting function of the TradeStation platform to test the strategy with different combinations of parameters values. The optimization can be done using the grid search or the genetic algorithm methods. And then evaluate the results. Compare the performance of the strategy across different combination of parameter. Look for the combination of parameter values that generates the highest net profits, highest number of profitable trades, and lowest drawdown. Not to forget to check for consistency of overall performance. Compare the performance of the strategy across different market conditions or time periods. The strategy's performance should be consistent across different conditions and time periods. Otherwise, the strategy's reliability will be questionable. If the results are consistent, it means that the strategy is robust and can perform well across different market conditions. And then we will do cluster analysis, which is first split the data set into two parts. One for the in-sample analysis, which was used to optimize the strategy, and the other part for this is out-of-sample analysis. And then we apply cluster analysis. Use the out-of-sample data to perform a cluster analysis, grouping the similar data points together based on their characteristics. For example, the data can be grouped based on volatility, trend, or any other relevant characteristics. And then we apply the strategy to each cluster. Use the optimized strategy to test the performance of each cluster separately. The goal of this analysis is to check if the strategy can generalize well across different market conditions. And lastly, we compare the performance of the strategy. And the last step in the framework of this study is the sensitivity analysis. How optimization can impact the performance of a strategy, you may ask? Well, by identifying the optimal combination of parameters, an optimization parameter study can help increase the profitability of a strategy. Other than that, by finding the optimal combination of parameters, an optimization parameter study can help to reduce the risk of a strategy. Next, an optimization parameter study can help to improve the consistency of a strategy's performance. And lastly, by using an optimization parameter, one can avoid overfitting, which is when a model performs well on the training dataset but not on unseen data. Next slide here is the data collection and data cleaning process. In this study, data was collected from the TradeStation platform, which is a well-known software for technical analysis and trading in the stock market. The data collected was historical price data of publicly traded companies in the US stock market, specifically for the top 10 companies over a period of 10 years, that is from the year 2012 to 2022. To obtain and clean the data, the following steps were taken. First, verify the data by checking for any missing values, outliers, or inconsistency in the dataset. Then, removing any duplicate or irrelevant information. After that, formatting the data to a common format and ensuring that the data is in a suitable form for the analysis. In this study, there are several general ethical considerations such as ensuring the accuracy and integrity of the data, avoiding conflicts of interest, maintaining data privacy, presenting results in a clear and unbiased manner, and several limitations that may affect the results of this study, such as limited scope of data, data availability and quality, backtesting limitation, out-of-sample error, indicator-specific limitations, and simplicity of the analysis. Last but not least, here's the conclusion of this chapter. The results of the analysis will be used to compare the effectiveness of the 4 indicators in identifying profitable trade opportunities. The ultimate aim is to determine which of the 4 indicators is more effective in stock market trading and provide investors with insights on how to better utilize these indicators for their investment strategies. That is all for my final year project presentation. Thank you.